Bloomberg Audio Studios.
Podcasts, radio, news.
Very happy to say alongside me, David Solomon of Goldman Sachs. David, good afternoon.
Good afternoon.
It's good to see you. Fantastic to see you in Paris as well. Paris, France. I think we need to talk about France first, and we'll move our way through the business and talk about the United States as well. Typically, I can say, as a Brit, that we used to look at France as sort of anti-business, not a place you'd want to put an employee. Perhaps you'd choose London over Paris. That seems to have changed. Am I right?
Well, it's evolved a little bit, and Brexit had a big impact on that evolution. We have between 350 and 400 people in Paris now. That's triple what we would have had, 5-6 years ago. So there's been an evolution. I do think it's still a complex place for a professional services person to put an employee. In our dialogues, here we've talked about that. It's one of the things, I'm encouraged by. I think the administration is looking to do things here that actually improve, this is a business environment. And I think one of the things that is interesting is we've chosen France. It's a very, very important hub for us here on the continent. But I'd also say our people like living here. And one of the things in a competitive world for talent is we give our people much more latitude to work and operate out of places that they want to live. And it's certainly a very attractive place to live.
I wanted to ask you directly, have you chosen France because somewhere else is getting worse or because France and the continent is getting better?
Well, I think it's a combination. France on the continent has gotten better. The regulatory structure requires that we have more people here for certain functions that are important to our business. Our clients are here, and we want to be near our clients. And so, it's a combination of things that make this an appropriate place for Goldman Sachs to continue to grow.
I think a lot of us going forward through 2024 into 2025 feel like we're flying blind a little bit. Do you have more clarity, more visibility on the future of Europe or the future of the United States?
I don't have a lot of visibility on the future of the world, let alone Europe or the United States. I know there are a lot of people that you talk to that are very sure as to how things will play out as we go forward. I tend to look at things and think about risks. How do we manage risks? What are the tails that are out there that we need to be concerned about? When I think about economic outcomes, I think about distribution of those outcomes. And so, there's a perception of the direction of travel. We can certainly talk about that, but I certainly don't know what the direction of travel is. I will say, going back to what we were talking about here in France and just listening to, a number of officials that spoke at lunch today, they're talking about ways that they can accelerate more entrepreneurship, more investment, more flexibility, and also more strengthening and interdependency in Europe. Those things are hard to execute on, but I think they are very important.
The White House is doing something similar, but it comes at a cost. I think the budget deficit was 6% of GDP, north of 6% last year, at a time when unemployment is south of 4%. Speaking of risks, is that one?
It's certainly one that I'm very focused on. I think the level of debt in the United States, the level of spending is something that we need a sharper focus on and more dialogue around than what we've seen. We obviously had a pandemic. We made a bunch of decisions, in that pandemic, but we're long out of that pandemic, and the spending levels, are continuing at a pace that I think is raising our debt level and creating issues for us down the road. So I think this is something that deserves a lot of attention. It's not getting as much attention as I'd like to see it get right now. We're obviously in an election year, so I'm not, I don't have my head in the sand. I don't think you're going to see that get a lot of attention prior to the election, but I do think it's something that requires focus. We need to deal with the debt and the deficits, and, hopefully there'll be a lot more discussion as we come through the election and move into the next administration.
Well, let's give it a bit of time now if we can. I often say that the United States has a privilege of behaving recklessly sometimes that maybe the likes of the Europeans do not. Have you sensed there's been any kind of pushback from the Treasury market, from investors, against the backdrop and this risk that we're talking about currently?
Well, the reserve currency is a great privilege. I'm not going to sit here and say that I see in the near term, a threat to that in any way, shape, or form. But it's not something that you can take for granted. And the United States' ability to spend without constraint is not unlimited. Ultimately, the market will challenge that. Hasn't challenged it yet. I'm not saying that's something that's coming soon, but it's certainly something that we should be very cognizant of and very protective of.
Do you think the experience of the UK a couple of years back was maybe a case study for what we could face in America?
Well, that was a disruption to the gilt market, and it's one of the things I think you need to be concerned about. It's a risk issue I've highlighted before. at the time, the Bank of England had to reverse its course and become very accommodative to deal with that blip in the markets. We've had disruptions of the Treasury market before. We certainly had a disruption in March 2020. To the degree that we had a significant disruption in the Treasury market sometime in the future, we don't have a lot of capacity through the banking system to intermediate that. It would require very accommodative policy. If that came at a time where that was not right for the central bank to be accommodative, that would be a risk issue that would have to be monitored.
We've had some big moves in the last 3-4 months. I can just think about the start of 2024. We were looking ahead to maybe 7 rate cuts priced into markets from the Federal Reserve, went all the way down to none. I think Jan Hatzius and the team are down to 2, July and November. Big swings in equity markets too, David. Can we talk a little bit about that? I think we're seeing 10% swings in trillion-dollar names post-earnings. Is that good for business, that kind of market environment? Is that what you want to see?
The market's the market. And, I think there are a handful of things that are driving these platforms to grow earnings very significantly and gain a larger importance in the overall market capitalization. These hyperscalers, as they're called, I think have enormous competitive advantages in the world that we're operating in. And it's not been surprising, given some of the changes in technology in the last 12 months, that their market caps have accelerated. I don't worry about that from a market perspective. I think markets are relatively efficient. I do worry that the structure of the equity markets, particularly in the United States, but this is true all over the world, are bringing fewer and fewer public companies, and that is concerning. There's obviously an abundance of capital available in private markets, but I do think it's important that we have open, accommodative, strong public markets. There's tremendous disclosure, transparency in public markets. I think that's good for capital deployment. And I am concerned that the breadth of the public markets is getting a little bit more narrow, and I think that's something for us all to watch and think about.
You've got visibility on the pipeline. Do you see that improving at all?
Well, it's easy to improve when it was zero. So the IPO market closed. It has opened up. We've seen some very successful IPOs during the course of the first few months of the year. I think the level of IPO activity will pick up in the second half of the year into 2025. It's not going to be as robust as it was during 2021, but I think we'll move back to what I'd call a more normalized environment for IPOs. That said, the overall size or number of companies coming public, companies are staying private longer, they have more access to capital, and that's something I think it's important for us to think about. There are consequences associated with that.
Let's think about M&A as well. It's difficult in my position to understand which deal can get done and which deal can't get done based on current regulation. Tapestry, Capri, apparently that's a problem. Other deals can go forward. How much is that holding back M&A activity in the United States?
I think there's no question that the regulatory environment has been a headwind to M&A activity. I'd say, for example, large cap tech is kind of closed out because of the regulatory environment for making significant acquisitions. And I do think the regulatory environment has made it harder to understand or really expect exactly how it will intervene. And so I think that's had a chilling effect. That said, the world's a competitive place. Scale matters everywhere you turn. People are going to do what they need to do strategically to advance their position. And if they have to litigate it, they'll litigate it. Generally, those companies that have chosen to litigate have generally made progress. Nobody wants to go down that path. But I think at the end of the day, scale matters and confidence matters. And so confidence has been improving over the last 12 months. Certainly in 2022 and 2023, you didn't have high CEO confidence. That affects M&A. But based on the indicators that we can see, some that are visible, some that aren't, I think dialogue's picking up, and my guess is we'll move back to what I'd call more normalized levels as we finish the year.
The stock is picking up on that, up double digits year to date, up something like 60% from the lows of October. I think Oppenheimer said the first quarter was a near perfect print. You must be feeling better, almost vindicated about where this business is going now and how appreciated that is.
Well, I've always felt good about Goldman Sachs and the way the business has been positioned for a long, long time. We have a plan. We've made a bunch of decisions over the last 5 or 6 years to execute on that plan. That plan has included our 1GS operating ethos. That plan has included putting more financial resources toward our client franchise and banking and markets, which has allowed us to meaningfully take market share from some of our competitors. We've grown our financing business, financing our clients, which is, plays to our strength given the way we're positioned. And we've also made some very strategic decisions over the last 5 years to bring a variety of businesses together in our asset and wealth management business. So we now have a real scaled platform in asset and wealth management, supervising a little less than $3 trillion of assets. And we're seeing margin improvement and growth in that business given the way we've positioned it. So I think the firm is very well positioned. We're executing on our plan. We're staying focused on our clients, and we've always been confident. What we can't control is the environment.
Sure.
I'd say 2022 and 2023 was not a great environment for our business. The environment's improved. I wouldn't say we're back to kind of, average environment, but we're getting there. And we're going to continue to stay focused on our clients and execute on our plan.
Let's talk about leaning into certain parts of the business. Would you be open to more acquisitions, particularly for asset management?
We're always, looking to grow and extend our franchise. Great asset or wealth management businesses. You don't buy them. They're generally for sale at certain points in time. You don't get to pick when those points in time are. At the moment, we're very focused on our execution. The bar to do something, very significant or transformative, I say this all the time when I'm asked, would be very, very high.
Yeah.
But if something came along at some point that we thought could accelerate our journey in asset and wealth management, bring accretive returns, strengthen our position, we'd certainly consider it. But at the moment, we've got a lot to do to drive our organic growth strategy, and we're making good progress.
Do you think those opportunities might be in Europe or elsewhere?
Well, we made an acquisition in Europe a couple of years ago, NNIP, which has been a good acquisition for us. It doubled the size of our asset management business in Europe, and it added certain capabilities, particularly around sustainable finance, that we felt were strategic for us. So we will, it wasn't in the context of Goldman Sachs, it was a $2 billion acquisition.
Sure.
It wasn't. But we're going to look. We have a strategy around our asset and wealth management business. We're executing on it. We've been very, very clear that we have room to grow and that we think we can grow this business high single digits and continue to improve the margins. And so we've got room to run, and so we're going to continue on that execution path.
You've been acquiring talent as well. The former Dallas Fed president, Mr. Kaplan, is making a comeback. What's he going to be doing?
Well, Rob had a long and very, very important career at Goldman Sachs. He ran the investment banking business for a significant period of time. Rob was looking to come back into the business, and we decided he should come home to Goldman Sachs, and we're thrilled that he'll spend time with our clients. Rob has deep client relationships. He'll spend time with our people. He's always been a leader as a mentor, to people. He believes deeply in Goldman Sachs culture, and so he'll be another senior leader that can spend time with all of us, on the culture of Goldman Sachs. We have 4,000 people in Dallas, Texas now, and he adds, it puts another senior leader in Dallas, which is obviously very, very important for us. And he certainly has a view on the macro that our clients are going to want to hear. And so having Rob coordinated with our research team and available to talk to our clients about what we see going on in the macro is another area we can contribute. So we're thrilled to have Rob back as a senior statesman at the firm, and excited that he was excited to come back to Goldman Sachs.
When I dial 1-800-GOLDMAN for their Fed call, do I call Jan Hatzius or Mr. Kaplan?
You call Jan Hatzius.
I keep calling Jan.
He's our lead economist, but Rob is certainly somebody you should call too. And by the way, I'd be happy to give you opinions on that also, as would John Waldron and 40 other partners.
How big is the range of opinions right now?
The range of opinions, we have a research opinion, but the range of opinions, it's one of debate. I think one of the things I feel so lucky, there's so many smart partners at Goldman Sachs that are out in the world talking to people, and as you do that, you learn. You bring perspectives to the table, and all those perspectives kind of go into the mindset factory. Jan Hatzius is really, really good at taking data and information and digesting it, and he sits in a very powerful place inside Goldman Sachs, and all of us contribute to that information flow. And so I think that's one of the advantages of the firm. We have a great ability to kind of listen and learn and talk to very smart people, and that gets incorporated into our views.
We'll get a ton of information this week. We get CPI, we get retail sales, a bit more data, tons more Fed speak. Can we finish on what the business is telling you about the state of the U.S. economy? We're trying to gauge if we're slowing down, falling off a cliff, or booming.
Well, we're definitely not falling off a cliff. I think the U.S. economy is chugging along pretty well. I think the market is set up for pretty much what you see now is what you'll get throughout the rest of 2024. There have been a bunch of data points that indicate a slowing in what I'd call the bottom 25 or 30% of the consumer economy, where people are making different choices and starting to tighten up on some of their spending choices. You've seen some earnings reports in the last few weeks that indicate that. But broadly speaking, the service sector is still relatively strong, and I think the economy is still in pretty good shape. Where it'll be in 6 months, how much of that slowdown we see in the bottom quartile, we have to watch the data very, very carefully.
Just a final question. We alluded to it in a conversation a little bit earlier. Do you feel personally vindicated about where the business is now versus some of the coverage the business got over the last 12 months?
Goldman Sachs is a visible organization. The team that I have that helps us, the board partners that help us serve our clients, run the firm, move forward. We've had a high degree of confidence in our strategy over the last 5 to 6 years. We continue to execute on that strategy. When times are good, things feel good. When times are tougher, things don't feel as good. But we kind of take a long view, execute against that strategy, and we just know that if we have really, really smart people working together, working collaboratively, really driving for excellence to serve our clients, we're going to do just fine. And that's kind of true north. Serving our clients with excellence, we'll do just fine. And so we remain focused on that.
David Solomon, thank you very much for your time. We appreciate it.
Thank you for having
France.
me.
And we'll catch up in New York next time.
Absolutely.
And save the flight. Thank you, sir.
Thank you very much.
That was David Solomon of Goldman Sachs.